It happened again. Silver didn't fall because investors changed their minds. Silver fell because the rules changed. A $5 drop in a single week looks like a crash on the chart, but the chart lies. Because after all that violence, silver is still holding above $70. That's the event. That's the signal most people miss. We're not watching a metal that broke. We're watching a market that just executed a controlled demolition of weak leverage. This wasn't sentiment. This was structural mechanics. The system purged the overleveraged, and the price held the line. If you want to understand who's really in control of this market, you need to understand why $70 held when the system tried to break it. This purge reveals the real battle underneath the price action. A normal price move has buyers and sellers finding equilibrium. It breathes. A rules event doesn't breathe. It falls until the forced sellers are done. And the timing is never random. Price jumps into the low 80s, volatility spikes, and the exchange raises margin requirements. That's the trigger. Higher margins aren't a market opinion. They're a risk management calculation by the clearinghouse. They change the cost to hold a position. For the leveraged speculator, it's a rent hike that happens overnight. You're holding a futures contract, a paper claim on metal you don't own. You put up a small deposit, the margin, to control a large position. The exchange decides that deposit is now too small for the new, jumpy price environment. They double the rent. You have a choice. Wire more cash immediately, or your position gets liquidated. Forced selling. Not because the trend reversed, but because your collateral became insufficient. This is the plumbing of the market. It has nothing to do with the fundamental value of an ounce of silver. The cascade is mechanical. The first wave of margin calls forces selling. That selling pushes price lower. The lower price triggers more margin calls for the next layer of leveraged players. The fall becomes self-reinforcing. It looks emotional, but it's arithmetic. The system is designed to protect itself from counterparty risk, and it does so by purging the weakest links first. This is why these moves are so violent, and why they stop so abruptly. They end when the forced selling is exhausted. The market isn't pricing in new information. It's flushing out excess leverage, and when the flush is over, the price returns to being driven by the underlying physical reality. The purge is a symptom of a market under structural stress, not a verdict on the metal itself. For decades, the number that defined silver's ceiling was $50. That was the psychological and technical barrier that contained every major rally. It was the rooftop. This time, price didn't just tap it. It blew through it and kept going. That breach changes everything. When a market decisively breaks a multi-decade resistance level, it rewires the entire psychology. The question shifts from if it can break to how high it can run before finding the next equilibrium. That's why $70 now matters. It's the first major platform built above the old world. The violent rejection from the 80s wasn't a failure to break higher. It was a stress test of this new $70 foundation, and the foundation held. The market threw its best punch, a $5 liquidation cascade, and price settled right back above this critical level. This is how new trading ranges are established. They aren't born from calm, orderly price discovery. They are forged in volatility. The market needs to know where the real buying pressure exists when the leveraged paper players are gone. Look at the price action. The smash was sharp, but the reclaim was immediate. It didn't linger at the lows. It didn't drift back down. It found a bid. That bid is the tell. It tells us that beneath the paper volatility, there is structural demand that sees value at these levels. The market is repricing the baseline. If $70 becomes the new floor, the level that holds during engineered turbulence, then the entire range shifts higher. The old ceiling becomes distant history, and the conversation moves to the next resistance level. This isn't about predicting a specific price target. It's about recognizing that the market's structural framework has fundamentally changed. The break of $50 was the declaration. The hold of $70 is the confirmation. Now, watch this. While the metal was getting whipped around, the mining stocks barely moved. Read that again. Silver ran from the 50s to the 80s, got smashed back to the 70s, and the companies that actually dig the metal out of the ground largely shrugged. That disconnect is not what happens at a market top. At a true blow-off top, miners go parabolic. They scream higher because the story is easy and the leverage is obvious. Everyone piles in. When miners lag, while the metal rips, it signals disbelief. The market doesn't believe the metal price is sustainable. And disbelief is fuel. It means the capital rotation hasn't happened yet. The big money, the institutional flows that move mining equities, are still watching from the sidelines. They're waiting for confirmation. They're the ones who need to see earnings. This is the smoke filling the room while people argue about whether there's a fire. We don't need everyone to believe right now. We just need them to show up late. The operational leverage is the key. A mining company has largely fixed costs. Labor, fuel, equipment, permits, these don't move as quickly as the price of the metal they sell. So when the metal price rises, revenue jumps, but costs stay relatively stable. The difference falls straight to the bottom line as free cash flow. A 20% move in silver can mean a 50%, 80%, or even 100% move in a miner's profitability. That's operating leverage. It's a silent multiplier that sits dormant until the metal price crosses a certain threshold. The upcoming earnings season is the catalyst. When these companies start reporting quarterly numbers that are multiples of what analysts projected, the disbelief gets expensive. The analysts who dismissed the rally will suddenly discover the trade. They'll show up with upgraded price targets and newfound conviction, acting like it was obvious all along. That's when the laggard miners catch up, and they don't do it gently. They gap up. The disconnect between the metal and the miners isn't a warning sign. It's a positioning opportunity. It tells us that the most powerful part of the move, the institutional validation, hasn't even started. This entire drama happens in the paper market. Futures contracts, ETFs, options, these are financial claims. They can be created and destroyed with a keystroke. The real tell, the signal that cuts through the noise, is what happens in the physical market. Because paper can whip, but physical metal doesn't negotiate. You can't print atoms. Watch the gap between the spot price on your screen and the street price at a dealer. When paper prices dip violently but dealer premiums stay high and delivery times stretch out, that's the market whispering the truth. The real metal isn't as available or as cheap as the headline price suggests. This divergence is the most reliable indicator of structural stress. It means the paper liquidation is a temporary phenomenon, but the underlying physical demand remains firm. Industrial demand creates an inelastic foundation. Silver is an ingredient. It's in every solar panel, every electric vehicle, every piece of electronics. This demand doesn't turn on and off with price volatility. A factory that needs silver paste for its production line doesn't cancel orders because the futures market had a bad day. They need the physical metal to keep their operations running. This creates a constant, relentless pull on actual supply. The supply chain cannot respond quickly. Opening a new mine takes a decade. Permitting, financing, construction. It's a slow, capital-intensive process. Even existing mines can't just flip a switch to produce more. So when demand rises, the physical market gets tight. Inventories in registered warehouses drain. This is the fundamental imbalance that the paper volatility often obscures. The paper market is pricing liquidity and leverage. The physical market is pricing scarcity and logistics. When those two worlds diverge significantly, it creates an arbitrage opportunity that eventually forces a reckoning. The paper price has to converge with the physical reality. It doesn't happen immediately, and then it happens all at once. Tracking this gap, the stubborn refusal of physical availability to follow paper prices down, is how you avoid getting hypnotized by a red candle on a screen. It's the difference between watching the weather report and feeling the wind. Now, let's talk about the big ship. While silver was getting tossed around in the storm, gold held steady. Gold dipped, but it didn't break. It didn't collapse into a crisis. This matters because gold is the anchor of the precious metals complex. Silver is the speedboat, fast, volatile, and reactive. Gold is the battleship, slow, heavy, and difficult to move. When the battleship holds its course, the speedboat can experience violent waves without changing the overall direction of the fleet. This relative stability tells us the move in silver isn't happening in a vacuum. It's part of a broader macro repricing of real assets. Central banks have been acting like they don't trust the old rules anymore. They've been consistent, relentless buyers of gold, moving away from certain paper assets and toward hard reserves. This isn't a speculative bet. It's a strategic hedge by the institutions that understand currency risk at a systemic level. When the entities that print money start accumulating metal, we should pay attention. Not because it guarantees a specific price, but because it reveals the risk they are hedging against. That flow, that structural bid, quietly supports the entire sector. Silver might not be the central bank metal, but it doesn't need to be. It rides the coattails of the liquidity and the narrative that gold's strength provides. The battleship's stability gives the speedboat permission to be volatile without the entire journey falling apart. The paper price can be manipulated by rules and leverage. The physical supply chain cannot. This is the most powerful, inelastic force underpinning silver. Industrial demand isn't a speculative fantasy. It's a logistical reality. Silver is a critical component, a raw material input with no easy substitute in a growing number of technologies. Every solar panel, every electric vehicle, every piece of modern electronics requires it. This demand is structural and relentless. A factory manager doesn't cancel a purchase order because the COMEX had a volatile week. Their production line depends on a steady flow of physical metal. This creates a fundamental choke point. The supply side is rigid. It can't respond quickly to price signals. Opening a new mine is a decade-long process of exploration, permitting, financing, and construction. Existing mines are operating near capacity. There are no large, low-cost silver deposits waiting to be turned on like a tap. Meanwhile, demand from the green energy transition is a one-way ratchet. Government mandates for solar power and electrification aren't optional. They are policy directives that create a guaranteed long-term pull on physical supply. Then you have the export restrictions and logistical bottlenecks. Major producing nations have become increasingly protective of their natural resources, sometimes restricting exports to prioritize domestic industrial needs. This further tightens the availability of metal on the global market. The result is a persistent drain on visible inventories. The stockpiles in exchange-approved vaults are the buffer, and that buffer is being steadily drawn down. The paper market can ignore this for a while, trading contracts back and forth based on financial conditions. But the physical market operates on a different clock. When the paper and physical markets diverge for too long, the pressure builds until the paper price is forced to snap back to reality. The supply chain doesn't care about margin calls or technical analysis. It only cares about the availability of real ounces. And right now, the trajectory of demand versus the constraints of supply point to one inevitable outcome: physical scarcity. That's the bedrock that the volatile paper price is built upon. And it's a foundation that is getting stronger, not weaker. Now we get to the core of the purge, the leverage trap. This is how the system systematically separates weak hands from strong hands. Most people see a sharp drop and think the market has turned. They don't see the plumbing. Futures trading is a rent versus own dynamic. You don't buy the metal. You rent exposure to its price movement by posting a small cash deposit called margin. This margin is your collateral. When volatility spikes, the exchange, the casino, decides the game has gotten riskier. They don't change the metal. They change the cost to play. They hike the margin requirements. Imagine you're holding a paper contract. The rent just doubled overnight. You have a binary choice. Wire more cash immediately to meet the new collateral demand, or your position gets liquidated. Forced selling. This isn't a decision based on your conviction about silver's long-term future. It's a margin call. It's arithmetic. You're out not because you're wrong, but because you're over-leveraged. This forced selling creates a cascade. The first wave of liquidations pushes the price down. The lower price triggers margin calls for the next layer of traders who are slightly less leveraged. The fall becomes self-reinforcing. It looks like panic, but it's a mechanical unwind. This is why these moves are so violent and why they stop so abruptly. They don't end when the smart money decides the bottom is in. They end when the last overleveraged speculator has been flushed from the system. The selling exhausts itself. And this purge does two things simultaneously. It punishes the gamblers who use too much leverage, and it hands a better entry point to the long-term physical buyers who are waiting for exactly this kind of engineered turbulence. The weak hands, who are renting exposure with borrowed courage, are forced to sell. The strong hands, who understand the physical underpinnings, are waiting to absorb that metal. The market transfers ownership from those who can't hold to those who will. This is the hidden function of these rules events. They cleanse the system of excess leverage, making the subsequent trend healthier and more resilient. The trap isn't the price drop. The trap is being in a position where a rule change can force you out of a trade you still believe in. Looking ahead, the market is currently positioned for one of two simple stories, and both are likely wrong. This is the three-story problem for 2026, and the third story is the one that changes the game for metals. Story A is the soft landing. Growth stays strong, inflation calmly drifts down to target, and central banks gently lower rates. In this world, everything is fine. Risk assets do well, and hard assets like silver are just another cyclical trade. It's a comfortable consensus narrative. Story B is the hard landing. Growth collapses, inflation evaporates, and the Fed is forced to cut rates aggressively. In this scenario, bonds rally hard and defensive sectors outperform. It's a story where traditional safe havens work, but it's also a story of deflationary fear, which isn't inherently bullish for commodities. But there's a third story, Story C, that ruins both of these tidy camps. It's the toxic mix, stagflation. Weak, stagnant growth combined with stubborn, persistent inflation. This is the environment where the policy toolbox is empty. If they cut rates to stimulate growth, they risk letting inflation run hotter. If they hold rates high to fight inflation, they crush the already weak economy. In this world, both bonds and high multiple growth stocks suffer. Bonds bleed because inflation erodes their fixed returns. Growth stocks choke because their valuations depend on future earnings that are jeopardized by economic weakness and high discount rates. This is the environment where real assets stop being a trade and start looking like a lifeboat. They are the hedge against the failure of conventional policy. Do we know Story C is guaranteed? No. But we can see the ingredients building. Unprecedented debt loads create fiscal stress, which incentivizes governments to lean against deflation at all costs. There is immense political pressure to paper over economic pain with liquidity. The path of least resistance for policymakers is often to allow inflation to run a little hotter rather than trigger a deep recession. When policy settings lean towards print and patch, the relative value of things you can't print, like silver, increases. The market is slowly starting to price this third story. The break of key levels in silver, copper, and other commodities isn't just about individual supply shocks. It's a signal that the market is starting to price a higher cost for real stuff in a world where financial asset returns are becoming more uncertain. The three-story problem means that the risks are asymmetrical. The downside for metals in stories A and B is a return to a lower range. The upside in story C is a repricing of what constitutes real value in a stagflationary regime. The recent volatility in silver is the market beginning to grapple with the rising probability of that third, much more disruptive narrative. Now we get to the real weapon, volatility itself. The market doesn't convince you with logic when it wants you out. It shakes you, it makes you nauseous, it makes you check the price every 5 minutes. That's not being informed, that's being trained. The violent red candle is designed to trigger an emotional response, not an intellectual one. Your amygdala lights up, your stomach drops, and your brain starts screaming sell before your prefrontal cortex can process the structural facts. This is the psychology of the shakeout. The goal is to separate emotional selling from structural selling. Emotional selling is fear-driven, reactive, and happens at the worst possible time, right into the teeth of a liquidation cascade. Structural selling is deliberate, planned, and based on a change in the fundamental picture. The purge we just witnessed was designed to maximize emotional selling. It was a test of conviction. The difference between a healthy purge and a broken trend is what happens after the shakeout. A broken trend sees price languish. It fails to regain the key level. A healthy purge sees the price rejected, but then it finds a bid and reclaims the platform. The weak hands get shaken out, and the strong hands use the opportunity to establish or add to their position. Your job is to maintain a cool brain when the market is trying to give you a hot stomach. The volatility is the fee you pay for being early. The market doesn't pay you for being comfortable. It pays you for being right when everyone else is panicking. The shakeout isn't the end of the move. It's the part that makes the next leg possible by clearing out the excess leverage and weak conviction. Now, let's talk about the fuel that hasn't even been lit yet, the rotation. A massive amount of capital is currently trapped in crowded narrative-driven trades, particularly in the digital asset space. That capital has a shelf life. Hype cycles eventually run their course. When a crowded trade stops working, when the momentum falters and the charts stop going up and to the right, the exit gets very narrow, very fast. The crowd that piled in during the easy money phase starts looking for the door at the same time. Where does that capital go when it leaves? It doesn't disappear, it rotates. And it doesn't rotate into more speculation. It rotates into assets that offer what it was missing. Real cash flows, tangible balance sheets, and dividends. It goes from chasing promises to owning cash-generating businesses. It goes to things that look boring right up until the moment they aren't. This is the hidden opportunity in the mining stock lag. The fact that miners haven't participated in the metals rally is not a sign of weakness. It's a sign that the rotation hasn't happened. The capital is still elsewhere. When that rotation finally begins, it won't be a gentle tide. It will be a violent re-rating. The short positions that have thrived on this widespread disbelief will turn into rocket fuel. A short seller survives as long as new buyers hesitate. But when a critical mass of institutional capital decides it's time to allocate to the sector, the buying is not discretionary. It's programmatic, it's large, urgent, and it targets the most liquid names, which are the large cap miners. This creates a squeeze on two fronts. New buyers are forcing the price up, and panicked shorts are forced to buy back their positions to limit losses. The result isn't a gradual uptrend. It's a series of gap-ups. The mining stock lag is the calm before the storm. It's the positioning vacuum that creates the conditions for an explosive move. We're not waiting for the metal to go higher. We're waiting for the crowd to finally recognize that the companies digging the metal are fundamentally repricing. That's the catalyst that turns a metals rally into a full-blown sector rotation. That purge wasn't a breakdown. It was a foundation test. Markets build higher floors through uncomfortable stress. A skyscraper doesn't build its upper stories in midair. It sets a base, tests it with weight, reinforces it, and then builds upward. The $70 level is that platform right now. The violent shakeout was the stress test. The fact it held is the reinforcement. These engineered turbulence events cleanse excess leverage from the system, transferring metal from weak, leveraged hands to strong, patient ones. A straight lineup is fragile. A base that survives a forced liquidation is robust. We watch for higher lows as confirmation of this new structural strength. The line held at $70, that's the signal. Now answer this in the comments. Who's really in control, the paper market with its rules, or the physical market with its scarcity? Subscribe now. The next structural alert lands here before the crowd sees it.